welcome to the Business Standard Morning Show. I'm Kanishka Gupta. It's the 8th of January 2024, and here are the questions we will be answering today. Does India IT have a talent management problem? What will be the stance of Interim Budget 2024? What should we expect from India Inc.'s Q3 results? And which law changes led to the truckers' strike? Tech companies reportedly fired over 220,000 employees in 2023. It was a jump of 40% from the previous year and a record too. But take this contrast. Demand for tech talent still outstrips supply. So why is it so? Does India IT have a talent management problem, or there's more to it than meets the eye? Ayush Mishra and Tariq Ahmed find out.
The Maharashtra government has issued a notice to Indian IT giant Tata Consultancy Services or TCS after receiving several complaints that the company forcibly transferred hundreds of employees to different locations and did not give them enough time to relocate. Nascent Information Technology Employees Senate, which works with IT and ITES and related sector employees, has reportedly claimed that TCS has stopped salaries of 900 employees who were opposing the forced transfers. TCS will present its case before the Maharashtra government on January 18. The Indian IT sector is facing headwinds on two fronts. While it is reporting deal ramp downs and cancellations from its foreign clients, on the domestic front, it is struggling to maintain an efficient talent pool. Last year was the bleakest. A staggering 226,000 employees were shown doors by tech companies in 2023. A year ago, the number was 202,000, suggesting a sharp 40% jump in firing by tech companies. But despite this, the demand for good talent is outstripping supply. An IMF report last year said that globally there will be a shortage of 85 million tech workers by 2030. India, which is also called the back office of the world, is also struggling with the same talent crunch. And this is giving many firms a tough time. IT giant Infosys and Wipro reportedly fired hundreds of freshers after hiring them. The reason? They failed an internal test. But many believed that the firms could have been a bit more cautious in onboarding these employees. At the same time, India's major IT sector players, American-based Cognizant, Infosys and Wipro, are embroiled in a poaching war, marked by lawsuits and accusations of unethical practices. The ongoing dispute can be traced back to the mass exodus of senior executives from Wipro and Infosys since 2022. Notable departures include CFO Nilanjan Roy and EVP Rajiv Ranjan from Infosys, and CFO Jatin Dalal and Growth Officer Stephanie Troutman from Wipro, among others. A significant number of these former executives found their way to Cognizant, worsening the tensions that have been brewing for several months. Recently, this problem escalated after Wipro filed a lawsuit against two of its former high-ranking employees, ex-CEO Jatin Dalal and Senior Vice President Mohammad Haq, after they joined Cognizant. Wipro alleged that Haq breached the non-compete clause in his employment contract by joining Cognizant. Simultaneously, Infosys entered the conflict by sending an official notice to Cognizant, accusing it of engaging in unethical poaching practices. Infosys claimed that Cognizant recruited over 20 employees for top management positions using questionable techniques. Cognizant's current CEO, Ravi Kumar, himself a former executive at Infosys, has brought on board several individuals with past affiliations to Infosys and Wipro. As a result, both Infosys and Wipro are now pursuing legal avenues against Cognizant. So, does Indian IT have a talent management problem?
Not be prudent to say that there is a talent mismanagement in the companies, because the companies that we are talking about, which are there in the news, have other biggies, who have been there for like decades and have always proven themselves. I think today the market situation is such where the business is becoming more competitive, the margins are becoming thin, and the talent is becoming dearer. And I don't think so that organizations today are in a position to compromise on the talent, because it directly has an impact on their billings, which has also an impact on their, the business forecast and all that stuff. And of course, talent is a very, very important element, in this entire chain that we're talking about.
Due to the economic slowdown in Europe and the US, the new deal wins for the Indian IT companies have gone down. This has pushed the Indian IT companies to reduce their discretionary spending. In IT, employee cost is the biggest expenditure with a weightage of 50 to 60% of the total spending. This has led to a drop in demand for active talent in the tech sector. According to the specialist staffing firm Xfino, demand for the active talent in the IT sector has gone down by 67% year-on-year in June 2023. But the right talent is still sacred for the IT sector, especially in the fields of AI, machine learning, and cybersecurity. And according to the experts, there is a dearth of quality talent. The poaching incidents are the likely outcome of this.
Everybody have the liberty to pursue new opportunities, and definitely competition will be eyeing for people who have done extremely well in the other organizations. So therefore, I don't think that unless and until there is any financial tie-up or a large financial gain that an ex-employee has got in the previous organization, that he or she cannot pursue other opportunities outside.
So, what is the way out?
The solution to the problem is that start relying more on creating rather than buying talent. Okay, definitely employability is going to be a vital criteria for organization, because they really can't hire just anybody. They have to ensure that those people are available, those skill sets are available in the market, and their organizations are also investing in creating those skill sets. Because if the business requires those skill set, then you have to ensure that those availability of talent is there. And that has to happen real time as well, because you really can't lose out on time in creating talent. And hence the organization needs to preempt at least a year in advance that what skill sets would be required, what are the technologies that would be there in about a year or 2 year time frame, that they can start working on the talent today, so that they can, they have that available pool as when the requirement happens.
Most experts believe that the IT industry has been finding it tough to attract and retain good talent. Upskilling and developing talent pipelines are some of the solutions to this vexed issue.
Next 6 months are likely to be crucial, as IT firms will compete with their domestic as well as global peers to get a pie in the upcoming $16 billion worth of IT deals. Well, it is good news, as deal wins will help boost the IT sector's prospects and in a way contribute to the country's growth. The government on its part is getting its expenditure scorecard ready. Interim budget will be tabled in Parliament on February 1st. Finance Minister Nirmala Sitharaman has ruled out any spectacular announcements. But foreign brokerage Jefferies has said the government will boost welfare spending in the interim budget. So what stance will the Interim Budget 2024 adopt? Watch Bhashwar Kumar's report to find out.
The announcement of Interim Budget 2024-25 on February 1st will see the centre maintain fiscal discipline as it adheres to the post-COVID-19 fiscal consolidation plan of reducing the fiscal deficit to 4.5% of gross domestic product by FY26. The government has budgeted a fiscal deficit of 5.9% of GDP in the current financial year FY24. The fiscal deficit was 6.4% of GDP in FY23.
An interim budget normally does not indicate a fresh position on what the government's fiscal position or fiscal consolidation plan would be. But given the fact that India will very soon be part of the JP Morgan Global Bond Index, my reading is that this interim budget will try to give out a clear signal that the path of fiscal consolidation going forward will be as important an article of faith for the government as it has been in the past couple of years. So I would say that yes, 5.9% of deficit will be maintained in the current year. And going beyond, the government would like to indicate that if it can be brought down by 0.5 percentage point or so in the next year.
While Business Standard's Asit Ranjan Mishra agrees that fiscal discipline will be a key theme in the interim budget, he also highlights the major challenge the centre will face.
One thing that this government can really be proud of is the consistent way it has met the fiscal deficit targets over the years, except the COVID years. It has committed itself to a glide path of 4.5% fiscal deficit by FY26. So for FY25, it should target something around 5.2% fiscal deficit. Whether the government will be able to achieve it or not will depend on a lot of factors, the key being the global uncertainty and how it plays out on India's growth and revenue collections.
Ahead of the interim budget, the centre's fiscal deficit for the first 8 months of the current financial year accounted for 50.7% of the full year target of 17.87 trillion rupees. This was much lower than 58.9% during the year before. Capital expenditure growth slowed in October and November. Controller General of Accounts data showed that the government had incurred 58.5% of the budgeted capital expenditure by the April-November FY24 period against 59.6% during the April-November FY23 period. Meanwhile, tax revenue was 61.6% of the budget estimates for April-November compared to 63.3% in the year-ago period. After a slight decline in major tax collections in October, November recorded a 21% increase in gross tax revenue compared to the previous year. The current year's budget has already taken a hit on account of a few additional relief measures announced during the year, leading to an additional cash outgo of 58,000 crore rupees during 2023-24. Thus, more cash outgo may have to be budgeted for, and that may become evident when the interim budget is presented. However, the continuing revenue buoyancy and a slowdown in expenditure may dilute the impact.
Meeting 5.9% of GDP as a fiscal deficit for the current year will not be that difficult. The tax revenue growth has been more than what has been budgeted for. What was budgeted was around 11%, but right now the tax revenue growth is well above 15 to 16%. So therefore, I don't see that the task of meeting fiscal deficit target for the current year will be a difficult job, even though the government's disinvestment proceeds have done very poorly with only around 8,800 crore till end of November this year.
Finance Minister Nirmala Sitharaman's recent statement that the February 1st budget would just be a vote on account and that industry should not expect any major announcement could mean that she will uphold the convention surrounding an interim budget. Of the 4 interim budgets presented since 2000, those of 2004, 2014 and 2019 ignored the convention of refraining from making big announcements of schemes or taxation measures.
When the finance minister said that there will be no spectacular announcements in the interim budget to be announced on 1st February 2024, I would read that as a sign that the government may not announce new schemes or new tax measures, but nothing stops the government from announcing or augmenting the resources allocation for schemes that are welfareist in nature. For example, there is nothing that stops the government from increasing the allocation for PM Kisan, which is an existing scheme, from 6,000 per farmer family in a year to say 8,000 or 10,000 rupees per farmer. I would not be surprised if an existing scheme gets more money, therefore giving a boost to the government's welfareist intentions. But yes, as the finance minister said, no new spectacular announcements, and which should be welcome.
Ultimately, the sanctity of the interim budget could be preserved if FM Sitharaman follows through on her statement.
The Lal Strait too will keep a close eye on the interim budget announcements. It will express its pleasure or displeasure through stock movements. Moving on, markets are set to kick off the December quarter earnings this week, with IT majors including Infosys and Tata Consultancy Services slated to report their numbers. In our next report, Nikita Vashisht presents a curtain raiser on the Q3 earnings season.
Equity markets began the calendar year 2024 with diverging trends. The broader indices extended their previous year's rally, but the benchmark indices backpedaled to nurse minor losses. For the week ended January 5, the S&P BSE Sensex ended 214 points lower, while the Nifty 50 slipped 21 points. The BSE mid-cap and small-cap indices, on the other hand, surged around 2.5% each during the period. Going ahead, analysts see the October to December quarter earnings for financial year 2023-24 setting the near-term tone for the markets.
Q3 earnings would be a mixed bag. However, based on the recent run-up which we have seen, we need to see whether markets will be enthused with the normal growth. I don't think there'll be major positive surprises sector-wise, except for some stock-specific earnings.
According to Baliga, sectors such as banking and infrastructure may do well this earnings season.
Among the sectors which should come out with better earnings would be infrastructure, banking and financials, cement, auto and auto ancillaries, pharma and travel and tourism. Whereas we could see cut in earnings as far as IT and OMCs are concerned.
Echoing similar views, Deepak Jasani of HDFC Securities expects aviation, railways, defense and realty to paint a rosy growth picture. However, he predicts consumer staples related companies to see earnings pressure.
IT services companies are expected to report subdued numbers for the December quarter due to continued weakness. Consumer companies could continue to suffer as rural demand setback is not fully compensated by urban demand growth. However, in terms of margins, they may use their cost optimization levers and report mildly better margins.
Overall, Kotak Institutional Equities expects sales of all the companies under its coverage to rise 4.4% year-on-year, while EBITDA is pegged to surge 14% on year. Net profit is projected to increase by 22% year-on-year. For Sensex and Nifty, the brokerage said Q3 FY24 net profits of the Sensex index could increase by 12% year-on-year, but decline 2% quarter-on-quarter. The net profit of Nifty 50 index, meanwhile, may rise by 12% year-on-year, but a decline by 4% quarter-on-quarter. Overall, Q3 earnings could see an extension of past trends, where inward-looking financials, real estate, and hospitality-related sectors may flourish, while the global demand-driven IT sector may remain weak. This week, December quarter earnings of Delta Corp, HDFC AMC, Infosys, TCS, HCL Tech, and HDFC Life will be in focus. Besides, retail inflation for the month of December 2023 will be on radar.
He's making plans for an early retirement. Business Standard.
After the earnings preview, let us now turn our gaze to Indian roads, which are set to see over 150,000 deaths every year. Government recently introduced new penal provisions in hit and run cases, but unions representing truck and taxi drivers have hit the streets against it. The government, which is now on the back foot, has assured them that its enforcement will happen only after wider consultations. Ayush Mishra tells more about this provision.
In 2022, India saw 67,387 hit and run cases, leading to 30,486 deaths, and over 54,000 people were injured in these accidents. These cases were lower in 2020 and 2021, as these 2 years were marked by movement restrictions due to the pandemic. But despite such a large number of fatalities, there was no specific provision for hit and run cases in the Indian Penal Code. Action was taken under sections for causing death due to negligence. In such cases, police invoked Section 304A of the IPC, where an individual causing death due to recklessness or negligence could be sentenced to a maximum of 2 years in jail or fined. Section 304A encompassed all hit and run cases and other activities leading to death through a rash and negligent act. But the newly enacted Bharatiya Nyaya Sanhita or BNS has dealt with the issue. Its Section 106(2) provides for a punishment of up to 10 years in hit and run cases where a person is killed and the driver escapes without reporting it to the police or a magistrate soon after the incident. While Section 106(1) of the Bharatiya Nyaya Sanhita deals with causing death by any rash or negligent act not amounting to culpable homicide, provides for a punishment of up to 5 years. India ushered in the new year with extensive traffic jams and lengthy lines at fuel stations due to a nationwide truck driver protest opposing the penal provision. Starting on Monday, drivers engaged in a 3-day protest obstructing major highways and roads across the country. But the strike was called off after the government assured the drivers' union that the new provisions will not be implemented before a wider consultation. Protesting truck drivers argue that the recently enacted law is harsh and unfairly targets larger vehicles. They also expressed apprehension about possible mob violence targeting drivers assisting the injured by transporting them to hospitals. Transport associations have reportedly written to the Home Ministry with some suggestions. These include, if a driver meets with a road accident, there should be a call center number so that the driver can immediately inform the government or administration about the accident. They also asked for cameras to be installed at various places. A police van and ambulance should be made available at every 25-kilometer distance on national highways.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
In 2022, at least 168,491 people died in road accidents in the country. Last year's numbers are yet to come. Well, that is all for today. For more news, views and analysis, please log on to business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.